Hello and welcome once again to another session of OA Accountancy Stuff. In today's video, we will continue with the double entry principle or the golden rule in account. As said in our previous video, this rule was propounded by an Italian mathematician known as Fra Luca Pacioli in the year 1494. So this is the rule that guides how entries are recorded in the various ledgers. So if you want elaboration on this, kindly check our previous videos. In today's video, we will take a full practice question on how these entries are recorded in the various accounts. So the question reads, Alhaji Baba started business on 1st January 2022 with a capital of $80,000. The following transactions took place during the month of January. On January 1st, purchase of furniture by cash $12,000. January 2nd, purchase of stationery by cash $1,000. On January 3rd, bought goods on credit from J. Thomas $25,000. On January 5th, bought goods for cash $17,500. On January 18th, sold goods to Brenda and Co. on credit $1,000. On January 20th, paid advertising expenses by cash $1,000. On January 25th, paid J. Thomas cash $17,500. On January 28th, paid rent by cash $1,500. And on January 31st, we paid salaries by cash $3,000. So you are required to open ledger accounts to record the above transactions. So these are requirements, and the rule as we elaborated in our previous video will guide us to record the above stated transactions in the various accounts. Let me remind you that in recording transactions in business, that's in accounting, one thing that's very essential and you need not to omit is the business that you are recording the transactions in. So in our case, Alhaji Baba started business on 1st January 2022. So what it means is that we are recording these transactions in the perspective or in the books of Alhaji Baba. So the first thing that you need to do is to write in the books of Alhaji Baba. Then you neatly underline before you proceed by doing what the requirement says. Anytime you are given a transaction, after you have written the books into which you are recording the transactions in, the next thing that you need to do is to analyze the transaction to know which books or which accounts are involved. As we said earlier in our previous video, every transaction needs to be recorded or needs to affect two accounts or two books. So in the first transaction, it says that Alhaji Baba started business with $80,000. That's capital of $80,000. So in this case, the two accounts that should be involved, or the two accounts that are involved, is the capital account and then the cash account. Why are we using the cash account? Anytime accounting transaction is silent about the source, that's the source of the money or payment, it is assumed to be a cash payment. That's when the transaction does not say by check or on credit, it is assumed to be on cash basis. Another thing that you need to be mindful of is that anytime a transaction says that started business with or additional capital introduced, whether it being by cash, by check, by assets, the first account that's affected is the capital account. Then you proceed by looking at the other account that's involved. So we will open our cash and then the capital account. The owner introduced a capital, or he started business with a capital of 80,000 Ghana cedis. So what it means is that the cash account of the business will be increased by the 80,000 Ghana cedis. That's the owner brought in 80,000 Ghana cedis. So it means that the cash account that's in the business will receive this 80,000 Ghana cedis. And we say that under the real account, the double entry for recording in the real account, it says that debit what comes in and then credit what goes out. So in this case, the cash account, there is cash that's coming in the cash account. So we will debit the cash account in the name of the capital, and then we will credit the capital account in the name of the cash account, because we said that every debit entry should have a corresponding credit entry, and there is no circumstance that a transaction will have a double debit. Thus, you debit the cash account and then debit the credit account. That's not possible in accounting. So the moment you get to know one side of the transaction, then it means obviously the other side of the transactions is the inverse of what you did in the first account. So in our case, we will first debit the cash account and then credit the capital account. So we will debit the cash account in the name of capital, $80,000. Then we will credit the capital account in the name of cash, 2022. And this are currency sign, January 1, in the name of cash, $80,000. So on the same date, we purchased furniture by cash, $12,000. And the double entry rule for recording in the real account says that we should debit what comes in and then credit what goes out. That's the double entry rule for recording in the real account. Real account contains items that are tangible, and a furniture is a tangible item. So the rule says that debit what comes in and then credit what goes out. In this case, we purchase furniture with cash, so it means there will be additional furniture and then a reduction in the cash account. So when there is additional furniture and then a reduction in the cash account, then we need to debit what comes in, which is the furniture account, and then credit what reduced or what goes out, which is the cash account. So we are already having a cash account here. We maintain the same cash account and then create another account for the furniture. These are currency sign in the year, the dates, and the currency sign. Okay, so we said we will debit the furniture account on the same January 1st in the name of cash, $12,000. And then we will credit the cash account in the name of furniture, 1st January, the name of furniture, $12,000. The third transaction also says that's on January 2nd, purchase of stationery by cash, $1,000. You bear with me that stationery is an expenditure, and I said in our previous video that the double entry for recording in the nominal account, it says that we should debit all expenses and losses. I said anytime a transaction is silent about the source of money or the payment, it is assumed to be a cash. That's when a transaction does not say the transaction took place through check or on credit, then it is assumed to be on cash basis. So in this transaction, we bought stationery with cash. So the two accounts that's involved is the stationery account, which is an expenses, and then the cash account. So in this case, we paid cash for stationery. So it means that cash is going out, and the double entry rule says that we should credit what goes out and then debit what comes in. And the double entry for recording in the nominal account, which is the stationery or the expenditure, says that we should debit all expenses and losses. So we will debit the stationery, which is an expenses, and then we will credit the cash account, which is a real account. You bring the year and then the currency sign. We said that since stationery is an expenditure, we need to debit stationery. So on 2nd January, we paid in the name of cash. We paid $1,000 for stationery. So we will debit stationery in the name of cash, and then we will credit cash in the name of stationery because we paid for this stationery through cash, and the cash will be reduced. So on 2nd January, you credit cash in the name of stationery account, which is $1,000. The next transaction says that we bought goods on credit from J. Thomas, $25,000. Another thing that you need to be mindful of is that in accounting, we only keep records of our debtors and creditors. That's under the personal account. We only keep records of our debtors and creditors. What it means that, though we said under the personal account that it contains records or accounts of business organizations and people the organization deals with, we only keep records of another organization or individual when the transaction that took place is on credit. That's the only situation that we keep record of another organization or another individual. So in this case, we bought goods on credit from J. Thomas, $25,000. So what it means is that we said under the personal account, the double entry under the personal account says that we should debit the receiver and then credit the giver. We bought the goods on credit from J. Thomas that were $25,000. So what it means is that we are the receiver and then J. Thomas is the one who gave out the goods. So J. Thomas is the giver and we are the receiver. But another thing that you need to be mindful of is sales goods and then sales, let's say, furniture. Sales goods in accounting is represented by the sales account and then sales furniture is represented by the furniture account. The reason for saying this is that in accounting, sales account is represented by the goods or the inventory or the stock that we bought with the intention of reselling them. So when we sell, let's say, our machinery, we did not the machinery with the intention of reselling. So this machinery is not recorded or is not considered to be part of the sales account. But in a situation where the organization deals with only machinery, that's when the organization sells only machinery, the machinery is considered to be under the sales account or it is considered to be part of the sales under that organization. But normally, the sales account is represented by those goods or stock or inventory that are bought with the intention for resale. So any other thing that we buy with no intention of reselling them is not considered to be part of the sales. The same applies for the purchases. Purchases account only contains the stock, inventory or goods that we bought with the intention of reselling them. So anytime we buy a goods with the intention of reselling, it is recorded in the purchases account. But when the organization does not deal with, let's say, motor van, and we buy motor van for, let's say, delivery or any other reason, that motor vehicle purchased is not recorded in the purchases account. But then anything the organization deals with, that's the routine activity the organization deals with, is considered, or anytime we buy anything that's the routine activities the organization deals with, it is considered to be part of the purchases account. So in this case, we bought goods on credit from J. Thomas, $25,000. Goods are bought with the intention of reselling. So obviously, the tool account that will be involved is the J. Thomas, because we said that we only keep records for individual or another organization that we deal with on credit basis. In this case, we bought the goods from J. Thomas on credit. So we will create an account for J. Thomas. So we have J. Thomas account, the date, and then the currency sign. And then the currency sign. We bought goods. So another account that should be involved is the purchases account, because we said a purchases account only contains the items, that's the goods, inventory or stock that are bought with the intention of reselling them. So we will create another account for purchases. We bought goods worth $25,000 from J. Thomas. So it means that J. Thomas has become our creditor. So what we'll be doing is we will debit the purchases account and then credit J. Thomas account. Why are we debiting the purchases account? We are debiting the purchases account because one, a purchases is an expenditure, that's purchases is an expenses. And two, the purchases account contains stock or inventory. And we said under the real account that we should debit what comes in and credit what goes out. So in this case, the goods are coming in, so we need to debit the goods account. And the goods account is represented by the purchases account. And then you will credit J. Thomas account, because under the personal account, we said that we should credit the giver and then debit the receiver. So J. Thomas gave out the goods to us, so we will credit J. Thomas in the name of purchases. January, J. Thomas. $25,000. And we will do same. We will credit J. Thomas account in the name of purchases. On 3rd January, purchases $25,000. We debited the purchases account in the name of J. Thomas $25,000 and credited J. Thomas account in the name of purchases. The purchases here and the J. Thomas here, they are the narration. They shows where the corresponding entry are recorded. So the next transaction says that on January 5th, we bought goods for cash, 17,500. We bought goods for cash. As we said earlier, anytime there is a cash transaction, firstly look from the perspective of the cash account. When you are able to analyze whether you will debit or credit the cash account, then obviously the other account will reveal itself, because there is no circumstance that you will have a double debit or a double credit. The moment you get to know that one account should be debited, then obviously the other account will be credited. So in this case, we are saying that we bought goods worth $17,500 with cash. So what it means is that we are sending cash for the goods, so the cash is going out. And when cash or real account is going out, then we need to credit that real account and then debit the corresponding account. So the corresponding account here is the purchases account, because we said that the purchases account contains the goods, stock or inventory that are bought with the intention for reselling them later for profit. So we will debit the purchases account, which we are already having here, and then we will credit the cash account. So we will first record the date, that's January 5th, in the name of cash, 17,500, and then we will credit the cash account January 5th in the name of purchases, $17,500. The next transaction also says that on January 15th, sold goods for cash, $30,000. On January 15th, we sold goods for cash, $30,000. And I said earlier that anytime we sell goods that we bought with the intention of reselling, it is recorded in the sales account. Thus, the sales account contains the stock, inventory or goods that we bought with the intention of reselling. So goods are mostly bought with the intention of reselling. So here we sold the goods for cash for $30,000. So we will create our sales account because we are not having it here. So the two accounts that are involved is the sales account and then the cash, because we received cash for the goods that we sold. And the double entry principle for recording in the real account says that we should debit what comes in. Here the cash is coming in, so we will debit the cash account and then we will credit the sales account. We are crediting the sales account because the sales account contains the goods that we sold out. And the double entry rule for recording in the real account says that we should credit what goes out. Another reason for crediting the sales account is because the sales account is a revenue account, and under the nominal account we said that we should credit all revenues and gains. The sales account is also a revenue, so we need to credit the sales account. So we open the sales account because we are not having it here. We will bring the date and then the currency sign. So the transaction says that we sold goods worth $30,000 for cash. So it means that cash is coming in and we need to debit the cash account in the name of sales. Then we credit our sales account in the name of cash. The date is 15th January. In the name of cash, $30,000. Then we come to our cash account and debit the cash in the name of sales. $30,000. The next transaction also says that on January 18th, we sold goods to Area and Co. on credit. That's worth $1,000. On January 18th, we sold goods worth $1,000 to Area and Co. What it means is that we sold the goods on credit to Area and Co. because that's what the transaction says. And we said that we only keep records of another organization or an individual when the transaction involved is on credit basis. So in this case, we sold the goods on credit to Area and Co. So what it means is that we need to open an account for Area and Company because Area and Co has become our debtors, and we need to open an account for them. So we open an account for Area and Company, and then the next account that will be involved is the sales account because the sales contains the goods that we sold out. So the double entry is we will debit Area and Co because they are the receiver. Under the personal account, it says that we should debit the receiver and credit the giver. Area and Co will receive the goods. So we will debit Area and Company, and then we will credit the sales account. So these are dates column, and this for the currency sign. You do the same for the credit side. We are already having the sales account here, so there is no need to open another sales account. We will maintain the old sales account, and then we record the transaction in the same account. So we said that since Area and Co are the receivers, we need to debit Area and Co and then credit the sales account because the sales account one is a revenue account, and we said under the nominal account that we should credit all revenues and gains. So we will debit Area and Co in the name of sales. So on January 18th, sales $1,000. Then we will credit the sales account 18th January in the name of Area $1,000. The next transaction also says that on January 20th, we paid advertising expenses by cash $1,000. We paid advertising expenses by cash $1,000. So it means that the cash is going out, and under the roll account, it says that we should credit what goes out. Another reason is we paid for advertising expenses, which is an expenditure, and under the nominal account, it says that we should debit all expenses and losses. So advertising expenses is an expenditure, and then we need to debit advertising expenses and credit the cash account because the cash account is going out or is reducing. And thus the double entry for recording in the roll account says that we should credit what goes out, and the double entry for recording in the nominal account, since advertising is an expenditure, says that we should debit all expenses. We will create an account for advertising expenses because we are not already having it. We are already having the cash account here, so there is no need to open another cash account. This is the date, currency sign, the date, and then a currency sign. We said we will debit advertising expense in the name of cash. So the amount involved is $1,000 in the name of cash. This next sign. 20th. And we said we will debit advertising expense in the name of cash. So on January 20th, in the name of cash, $1,000. Then you will do the same for the cash account. So you will credit the cash account in the name of advertising account or expenses. The next transaction also says that on January 25th, we paid J. Thomas cash $17,500. We are already having J. Thomas account here, and we paid it through cash. So what it means is that we will first look at the perspective of the cash. What happened to our cash account? We paid through the cash account, so it means cash is going out. So we will first credit the cash account, and then we will debit J. Thomas account. So the question said that we paid J. Thomas by cash $17,500. So what happened to our cash account? Let's first look from the perspective of the cash. What happened to our cash account? The cash account will be reducing because we paid through the cash account. So if the cash account is reducing, what should happen? we need to credit the cash account. Firstly, we will debit J. Thomas account. The next transaction also says that we paid rent by cash 1,500. We paid rent by cash. So let's first look from the perspective of our cash account. What happened to our cash account? We paid rent by cash. So it means that our cash account will be reduced. So if our cash account is reducing, what will happen? We need to credit the cash account, and the rent also is an expenditure. The double entry for recording in the nominal account says that you should debit all expenses. So what it means is that we will debit the rent account, which is an expenses, and then credit our cash account because the cash will be reducing. We are already having the cash account here, so we will create an account for the rent account. So we said we will debit the rent account and credit the cash account. So on January 28th, cash 1,500. Then you come to our cash account on January 28th. We paid for rent. The last transaction says that we paid for salary worth $3,000. So what it means is that we are already having the cash account here. So we open an account for the salaries, and then you will debit the salary account and credit the cash account because the cash will be reducing because we paid through the cash, and then salary is an expenses. So we need to debit the salary because that's what the double entry for the nominal account says. So we open an account for the salaries. And we are saying we should debit the salaries and credit the cash account. So on January 30th, in the name of cash, $3,000. Then you come to the cash account, January 30th, in the name of salaries, $3,000. So this will be the end of the part 2 of the double entry principle. In our next video, we'll be looking at how to balance off an account and extract a trial balance. So if you are new to this channel, kindly subscribe and share for the benefit of others. Also, you can comment under the comment section to show how helpful this video has been to you. Thank you and bye for now.